Hey everybody, how you doing? Eric Worrell here with rentprep.com, and always excited to have a friend of the podcast and these live videos that we do for everybody on here, where I'm joined by Mark J. Kohler. How you doing, Mark?
I'm doing great. Thanks for having me.
All right, so I'm going to do my best, Mark, to do your introduction because I know you got kind of a pretty long rap sheet of
Oh,
accomplishments, but Mark is a CPA, an attorney. He works at the KKOS law firm, and you guys are what, in like 3 or 4 different states, right?
yes. Well, we help clients all over the country, but we have four locations: Arizona, California, Idaho, and Utah, where we have, I guess, base camps, if you will. But we're helping
Yep.
everywhere.
And you've got plenty of books on Amazon that are all bestsellers. You have the Refresh Your Wealth podcast and radio show, which does great on how to, not necessarily make more money, but keep more money. And what else you got? What else am I missing here?
Uh, that sounds great. Yeah, just books and the podcast. And let me think. Speaking around the country. Got a workshop in Chicago next week. I'm going to Honolulu, which Eric, you should come to. It's a great
Yeah.
tax off. December 1st, and then back to Orange County. So broadcast news interviews was on NBC last weekend, just talking about LLCs.
Hmm.
That'll be a piece of this conversation, of course, because whenever you're doing 1031s and opportunity zones, how does this LLC fit into it? So we'll talk about that. And I'm cranking, and my podcast makes you money. It's not just saving money. You know, we're
As I was
self
saying that, I was like, he's like, no, 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 it does both.
Yeah, we're self-directed IRAs and 401ks. We were the leaders of this 20 years ago, helping people direct their IRAs and buy rental properties. And I know many of you are a part of Rent Prep do that. So
Mhm.
anyway, good. I'm awesome. And thanks for having me here.
Yeah, of course. So today's video is going to be mostly about 1031 exchanges, and I thought we could start with talking about those. And I know some of our audience in the Rent Prep for Landlords Facebook group, it comes up here and there, and then other people aren't really sure what they're talking about. And then from that, I thought we could kind of evolve into opportunity zones because it's kind of a nice segue. And then towards the end of this video, what we're going to do is we're going to open it up to Q&A. So if anybody has any questions at any time during this, feel free to comment below. I'll kind of put that on the screen because we can pull your comments up on the screen, and we'll kind of reserve those for about 10-15 minutes out once we kind of get a baseline on 1031 exchanges and opportunity zones. So at a real quick glance, Mark, like if you're talking about both of those, like it's just basically about saving on taxes, right?
Yeah, and I will say this: I'm glad the you're going at it this way. I think it's easier to understand opportunity zone once we understand 1031 exchanges. 1031 exchanges have been around for 30 plus years, and opportunity zones literally just got dropped on us this year with the Trump GOP bill in January.
Mm.
And it's pretty freaking amazing. It's very similar to what they did down in Texas and Louisiana with the Katrina opportunity zone 10 years ago when we were trying to rebuild Texas after Katrina hit. And they had so much success with that when Trump and GOP got to put together a package, they wanted to throw that in there. So, but we can understand it better once we understand 1031s. It's about saving taxes, deferring taxes, uh, paying no tax at all in some of these equations. So yeah, it's if you invest in real estate, you got to know both strategies. You really do. And I'll try to keep it light and interesting and fun. And I've got a lot of free content for many of you that are watching this, where you can just maybe follow my newsletter. It's free, and get second opinions and tips from my team and myself,
Mhm.
because your accountant or lawyer might say, oh, do this. And you're like, well, that sounds weird. Mark says this. You might always need to get a third opinion and try to break this up. I'm teaching attorneys and CPAs around the country, and there's a lot of misinformation out there. So that's the goal today, is just get you enough so you can be a captain of your ship.
And I will warn people about his newsletter because you'll be trying to do work and then all of a sudden you'll find some super interesting like tax angle that he's talking about. And next thing I know, I'm reading about like how to write off your work truck and like go down the Mark J. Kohler vortex, But yeah, so Mark, if we're talking about 1031 exchanges, basically for someone who's never heard of it, what is a 1031 exchange?
You bet. And this is a great baseline for everybody to know out there. And I'm going to ask for your patience, everybody. If I turn off screen and cough a little bit, I've been dealing with a head cold all week, and I feel fine, but my throat's still catching up to me. So a 1031 exchange says, hey, I've had this property, and 5 years, 10 years, usually a little bit of time, there's been some built up of equity. And if you sell it, you're going to pay some tax on the capital gain. And by the time you do cap gain at 15 to 20% and state tax, possibly even Obamacare, you could be at 25 or more, 27% tax. And if you're going to make 100 grand on this thing, do you really want to write a check for 25 grand or more to the IRS and state? And you're like, ah. And so the 1031 exchange says, hey, if you're going to take the money from the sale of this property and go buy another property, you don't have to pay the tax. You can punt. You can kick the can down the road. You can defer it. So as long as you take that sale, if you sell something for 200 grand and go buy something of equal or greater value for 200 grand, you're done. 1031 exchange works. You can do as many as you want in 1 year with as many properties as you want, sell one property, buy another one of equal or greater value. Now that's the concept. And then it gets crazy because here's what's cool. First, you can take property in one state and sell it for property in another state. You can take a Mississippi swampland and exchange it for LA downtown commercial high rise. You can take oil rights. You can take water rights. Anything that's deedable real property can be exchanged for other deedable real property. It can be a single family home for a duplex. It can be a meth lab rental for a doctor's office building. So very broad. Now, you can't do this with stock or capital gain from other sale of assets like a business. It has to be real property, but the definition's quite broad, so it's not too long.
Okay. You know what? I said we were going to kind of do Q&A at the end, but I thought we had a good question in here that relates to 1031 exchanges. Stephen Line here, he said he has 1031 exchange. You have 45 days to identify the property you want to purchase after selling the property. You know what? That one's actually on opportunity zones. So why don't we get to that later? But we do have a question here that yeah, we can get to that. Sorry. This one comes from Chai. She says, if I am selling my rental in a Texas LLC, and I'm going to 1031 it into another rental in a Florida LLC, do both LLCs have to have the same managers and members in order to work?
Actually, Chi, you have to have something even more different than that. It doesn't matter who the managers are. It doesn't matter who the members are. You have to have the same seller going to the same, when you sell your property, whatever you buy has to go back into the same name of the seller. Mm-hmm. So if you have a Texas LLC and you're selling a property and you want to 1031 it, option one is to register that LLC in Florida, because you're going to have to close on the sale in the name of that Texas LLC and then close on the purchase in Florida in the same LLC that was in Texas. So what we would do is just register that LLC foreign in Florida. Now, once the 1031 exchange is over, you can domesticate the LLC, meaning, in fact, we could even do that. That's another option. We could move the LLC to Florida during the closing. And so, but you're going to have to close in the same name. You can't set up a new LLC and make this happen. Another option, option 2 or 3, is to deed the property out of the LLC into your own name, go through the sales transaction, close it in your name in Florida, then deed it back into a new LLC in Florida. Now, there's more steps involved there, but depending on the banking situation, you might need to do that. Because if you're going to go get a new loan in Florida, banks drive us crazy, and sometimes you have to close in your name to get the right banking structure or product you want, then turn around and put it in an LLC. And folks, it does not screw up the 1031. Don't let your accountant freak you out and go, oh, if you deed it to an LLC after, you're screwed. The IRS understands there's an asset protection motive. If you're not transferring the underlying ownership to someone else, you're going to be fine. So she does have a point here. If you're going to try to change ownership in the mix, you're going to have a problem. Mm-hmm. Whether it's a new LLC or 2 months later, some new owner mysteriously happens, yeah, you're going to jack it up. This has got to be your property sold for another property that you're going to own, no new owners in the mix in some backhanded way. So now let me go back to that other question on timing, because even though he brought in the word opportunity zone, he does bring up the 1031 timing. So when you do this, again, I said you can change any type of real estate for any other exchange for other type of real estate. The cool part is, and as we get into the timing, you can just sell 3 properties and buy 1. Mm-hmm. You could sell 1 and buy 3. So I could sell a $200,000 property and buy 2 $100,000 properties, and I still qualify as long as what I buy in total value is equal or greater to what I sold in total value. So the numbers can be very flexible. But there's timing. Once you sell the first property, you've got 45 days to either buy what you're going to buy, or in a written letter that has to be documented and time stamped, I'm going to identify 3 options of what I will buy.
Okay.
Well, I found 3 properties that'll probably work, and I'm going to keep moving towards those, but you have to do that in writing within 45 days. And then within 180 days from the day you closed, or 145 days from when you identified, you've got to actually make the purchase. So that's a 6-month time period. So now you can understand, I give 1031 classes that can be an hour or 2 hours long. So Eric, you got to rein me in, but I'll just say in summary that there's some timing. And what I tell people is, if you know you're going to do a 1031, start shopping for what you're going to buy now. Get the property up for sale and start shopping. Make offers contingent on a closing on a 1031. That you're not up against this 45. Don't start the 45 days the day you sell and go, oh, I better start looking. Start looking now. And it makes the 1031 much more fluid.
I do have a question on that. So let's say you do the time-stamped option where you say, hey, I've got these 3 properties that I'm interested in, and then you have pretty much like 180 days. Does it have to end up being those 3 properties, the ones that you purchased for the 1031, or can you, if another property comes in, can it be that one if it wasn't on that letter?
No, it needs to be one of the 3 you identified.
Mm-hmm.
You choose these 3 that are options, and you've got to actually close on one of those 3. Now, you will see people, excuse me, push the envelope, and they may close on something else that wasn't identified. And if they were audited, they'd have some explaining to do. But I want to do it in a way so that when you go up that elevator into heaven and Peter meets you at the pearly gates, you can say, you know what, I never cheated on my taxes. That's what we're shooting for. So anyway, there are people play some games there, but the technical rule is you should be closing on one of the 3 that you identified.
Okay. Do you have anything else that you want to kind of put in right now on 1031 exchanges, or do you want to go over into opportunity zones?
Boy, I think we covered it. Deeding your name out, dealing with the banks can be a problem. They're very affordable. You're going to pay an accommodator. Let me make this last point. When you do a 1031 exchange, you're going to sell your property, and then the money's going to go into an accommodator. Think of it like an escrow, and you're going to go shopping. If you even think you might want to do a 1031, the cost may be $300 to $500 to just start the 1031. Not bad. Put the money in escrow. If you find your properties and you do the 1031, great. If you don't, escrow will just write you a check. But if you don't put the money in escrow and go, oh, I want to do a 1031, and you didn't follow that step, you can't go back in time and pull it together. So it takes a lot of planning up front to make sure I'm going to go for the 1031, or at least use it as an option. Let me put the money in escrow, go shopping. I'll identify even 3 properties. But if one of those 3 fall out, fine, I'll pay my taxes. But at least I've got that option there. And then when you close, that money will go out to the new property you're buying, and that money transfers. So it's kind of like a triangle. You're selling to a buyer, the money goes in holding, and then that money goes to a new seller. So it's called an inter-party transaction that an escrow brings it together. So it's somewhat technical. I think it's fun, exciting, but I'm a geek. So anyway, that's the 1031, folks, and it's a great. And oh, by the way, you can 1031 a property, 1031 it again, turn 1031 it again till the day you die. So
you could have 5 properties over the course of 20 years, and you're still not going to be paying taxes on the capital gains of that first property because you keep 1031 exchanging it. Is that correct?
Right. Okay. And then you just exchange. And then when you die, your family gets stepped up basis, no tax at all. Or you could do a charitable remainder trust, no tax at all. So somewhere down the road, there's other options to still get rid of that tax bill that's been collecting over time.
Mm-hmm.
And some planning could really help.
Okay. First, we got a nice shout out for Mark here. This came from Matt. He said, Mark is awesome, has seriously helped us out and saved us thousands of dollars. So I thought we'd throw that up there. And then Matt, he had a good question here. He said, when exchanging, do I need to reinvest the net proceeds or the sales price?
Okay, when doing a 1031 exchange, and this is going to be the difference with 1031, when you're exchanging, you need to reinvest the sales price. So if I sell a property for 200 grand, and maybe there was a mortgage on it for 150. So, and let's say my capital gain was even just 50 grand. Let's just hold together a very simple concept there. Sell it for 200, had a mortgage of 150. I bought it for no cash down 3 years ago for 150. It was an interest only loan, just very simple concept. I've got this mortgage. So I sell the property, pay off the mortgage. I've got 50 grand and I'm going to pay tax on that. Oh, to do a 1031 exchange, I've still got to go buy a property of 200 grand and $1. Mm-hmm. So that way to defer the 50, I've got to go get a new mortgage and buy a new property of equal or greater value of what I sold, not of the net proceeds. So,
okay.
We'll keep talking.
Yep. I'm actually a little bit curious as far as the proceeds and capital gains. So like, let's say that you have $100,000 property that you purchased. It is now worth, we'll say 175, right? So if you sold it, does it matter how much mortgage you have left on the $100,000 property, or is it purely about that $75,000 of appreciation?
Well, it matters. I know this sounds maybe redundant, but all that matters is the sales price for purchase price. You might actually put some more cash into it and get less mortgage. You might get a greater mortgage in order to cover the selling costs and purchase costs. So the mortgage could vary. Your cash down could let's get real. What a lot of people do is sell a property for 200 grand and they go buy 3 more properties or another one for 400 grand. So you might come to the table with even more cash or a bigger mortgage, but you've deferred that tax along the way. Okay. So frankly, again, the mortgage amount can vary, the equity could vary, the depreciation carry forward can vary, your cash down can vary. What controls a 1031 and making it valid is buying a group of property of equal or greater value than what you sold.
Okay. So, very cool. So what we'll move on to right now is opportunity zones. I brought this up on the podcast, and thank you. I reached out to your assistant, and Mark was gracious enough to let us use some audio from a YouTube video that he has. Actually, it's linked in the live video here right now. That audio was used on our podcast to kind of tee up what opportunity zones are. And I think this is a great thing to be talking about for our investors, especially that are comfortable in kind of investing in lower income areas. So Mark, just let us know what exactly is an opportunity zone for someone who maybe hasn't heard of it yet.
You bet. And I saw some comments earlier, you and I were talking about, Eric, that some people are a little down on them. They're going, oh, these are trashy areas. Now, hear me out. What opportunity zones are about is rehabilitating or revitalizing areas around the country that need some help. And again, the government, I say this in the YouTube video, the government really sucks at trying to go make places better. The government's good at it. We as investors are better at it. We have boots on the ground. We know what's going to make money and what tenants want and they're willing to pay. So an opportunity, when they decided to do this, they said, let the governors of all 50 states choose around 50 zones in their area of their state that they think need help. And they get to choose these 50 areas to submit them to the federal government. Then they're going to go on this list. So across the country, there are 4,700. They even came up with more than 50 per state. It was like 50 to 100, varying on the size of the state. There are actually 4,700 opportunity zones. And you could sell a property in New York and invest in an opportunity zone in Albuquerque, New Mexico, right outside, Breaking Bad car wash. So, I mean, you could go from one extreme of the country to another to help revitalize Albuquerque, New Mexico. So these opportunity zones are all over the country. And here's another point. I know some of your investors are like, Mark, I only do grade A. I'm doing college housing, 40 units or more. They're high end, they're class A. That's my motive. Okay, cool. Don't get all hot and bothered about opportunity zones. But I've got other clients that make millions as well, buying and selling and renting meth labs. And, and I say that jokingly, but they're going to work in low income housing. I own a low income housing rental. I've owned it for at least 8 years. It's been phenomenal. I get Section 8 guaranteed rent from the government. Yeah, I'd never want to live there. Freak, I won't even drive by there after dark. But it's still cash flows.
Mm-hmm.
So guys, we have to sometimes think outside of the box. And maybe we need to add some diversification to our rental real estate portfolio. And doing an opportunity zone project is one of these areas that could get us into low income housing, but it also creates great cash flow. And hey, and Eric, you know this, what's crazy, we could take a half an hour here and just go through the country and look at parts of cities that have been revitalized,
Mm-hmm.
and their values have skyrocketed. You know, no one was going to invest in South Philly 8 years ago, but now look at it, it's like 1,000% increase in real estate value.
Mm-hmm.
Now, so this is what the government's saying: take a risk, come help us revitalize this area, and you could be a huge winner with it. So that's the concept of opportunity zone in and of itself.
Okay. One of the things that I find interesting on it, and correct me if I'm wrong, for a 1031 exchange, you're exchanging essentially real estate for real estate.
Yes, yeah, it has to be real estate.
For an opportunity zone, you can do other things besides real estate, correct?
Yeah, now here's where it gets good. So, and some of you that have watched the YouTube video, and this may have spurred some questions, and that's why we're here. And again, Eric, thanks for having me so we can peel the onion away here. Is the first thing that's cool, and Matt, this goes back to your question. All you have to invest in the opportunity zone is your capital gain, or maybe the net proceeds. So you don't have to do the sales price. So that's point number one, which is huge. So if I only made 50 grand on that property, but it's a $200,000 sales price, I could actually go invest the 50 grand and pay no tax. I can even start a 1031 exchange, identify my 3 properties, but then pull the 50 and go, ooh, I'm going to do an opportunity zone, pull the ripcord on the 1031 and still pay no tax. So you can simultaneously be working both of these options at the same time. And then what you said is great. It could be any capital gain. It's not just rental property. You could sell stock in Facebook or Albertson's grocery store that you've held for 50 years and you're ready to sell it, and you're selling it now at a gain of 100 grand. You can exempt, or not exempt, but well, there's an exemption piece. But anyway, defer the gain and take the 100 and go buy a rental property 100, or go get a mortgage and buy something of greater value even, but reinvest that 100 capital gain and you qualify. So,
and now you were mentioning as far as like an exemption, what were you getting at there?
Okay, so this is the tricky part. So let's say I go sell my property for 200 grand. I've got capital gain of 50, and I'm like, I'll start a 1031. We'll see how it goes. Meanwhile, I'm going to look in these opportunity zones. I get looking, I'm shopping around, and I just find this little opportunity zone rental property for $50,000. So all I have to do is take my net proceeds of 50,000 approximately, which is going to hold it all constant. I take my 50 grand and I go buy this little opportunity zone property. I don't pay any tax. I fill out my form. I'm now in the opportunity zone time period. Now, if I hold that property at least 5 years, because I'm the government saying, bet with us, please come help this area, make that property better, which you're motivated to do. Your original capital gain of 50,000 is reduced by 10%. So if you'll at least hold the property, there's an elimination of capital gain of 10%. Then they go, play with this longer. If you'll at least hold it 7 years, we'll give you an additional 5%, which is 15% off the original capital gain. So instead of this 50,000 capital gain, you're going to get to exempt 3,250 or something like that.
Okay.
So, excuse me. I appreciate these patients here.
So a question that I was thinking of, we were talking, you said you got 45 days on the 1031 exchange for until you purchase the property unless you use a letter, right?
Mm-hmm.
What's the time limit with an opportunity zone if you're selling? What kind of time frame are you dealing with?
You bet. And we're dealing with IRS regs on this that are still coming out, because this tax law was just passed 9 months ago, guys. We're still figuring this out, 10 months ago, whatever. Our understanding is you need to do it before you report your tax return, because you either got to claim the gain or show that you reinvested it. So I don't know if the time deadline is going to be December 31st this year or April 15th. In fact, I'm willing to get back to you on that. I don't know if I even have the answer on that one, but you either got to report the gain. I have a feeling, I'd love to say that it's you have to reinvest that gain before your tax return is due with extensions.
Okay.
So you would have until probably October 15th of next year, theoretically.
Okay.
But anyway, okay. So now here's where it gets better. I'm going to throw in a Ginsu knife, paring knife with this whole set. It gets even better. So let's say you take that 50,000, you go and invest it in this property, you hold it 7 years, you exempt 15% of it from tax. At that point, the government says you did it for 7 years. Thank you so much. We'll exempt 15%, but on the year 2026, you're going to have to pay the tax on that capital gain. There's no more deferment. You can't do it again. You can't roll it over. You can't do a 1031. You got to pay the tax now on that 50 grand minus the 15%. Well, at that point, the tax is paid, but they say, now we'll give you one last bonus. If you'll hold the property just 3 more years, so you're now into this property 10 years, any gain that you had from the original $50,000 purchase price, let's say you were in this dilapidated area and the value doubled in that area over the 10 years, now it's worth 100 grand, no tax at all.
Yeah.
In perpetuity, ever. You'll never pay tax on that property again on the date of sale. There's no capital gain. Now, if you have rental income, you'll pay tax on that. But if you can hold it at least 10 years, when you go to sell it, zero tax on the amount of the purchase price of that opportunity zone property to what it's due in the future. And cities are getting behind this. Counties are getting behind this. States are getting behind this because they're saying, hey, get these investors in here, and if they'll come buy all these properties, we'll put in a new library. We'll put in a convention center. We're going to get hotels to come in. We're going to get all these other things to come in and revitalize this whole area. And your property could double or triple in value, and you'll pay no tax on it.
Yeah. Yeah. I think that's a great incentive to kind of keep people in there beyond 10 years, because they might say, you know what, this neighborhood might even be crazier in another 10 years. And if you know you're not going to be paying any tax on the capital gains, that's awesome. As far as you know, we got a question here from Rich, who actually works at our office. I was talking to him about this, and I said, hey, Rich, why don't you just comment here so we can put it up on the screen? He said, are there any other stipulations beyond 10 years? So you said you got to hold that property for 10 years, and there are no, you pay zero tax on appreciation in the opportunity zones. Is there anything else beyond that you have to be aware of?
From a tax perspective, I would say no. I think I already alluded to it. I will say this: you'll continue to calculate your depreciation. You're going to write off your mortgage interest if there is any, and all those little tax strategies that go with it. I love rental property, going and checking on it, taking travel write-offs, making sure you or your spouse qualify as a real estate professional. You're going to pay tax on the rental income. It's just the capital gain that's exempt. So let's keep that in mind. It's the capital gain when you go to sell 10, 15, 20 years from now, whatever that is. If you die in the process, you get stepped up basis anyway at that point. I don't know if your family, this is a good one, Richard, because I don't know if your family would inherit the opportunity zone exemption, or would they just get stepped up? Does that exemption die with you? That's a good one. I doubt senators thought about that one.
Yeah.
Now, I do want to say this is a little other things to be aware of. And we talked about this so many times, Eric, before, so forgive me for giving it a plug. Make sure, people, you've got all your rental properties in an LLC or multiple LLCs, your eggs in different baskets. And when, especially if you're doing an opportunity zone property, you're going to be in a low income area. It's going to be a higher risk tenant, higher risk area for accidents. And you may say, well, I've got insurance. I have umbrella. Guys, insurance and umbrella don't cover everything, especially when you have crazy low income tenants. You don't know what you're going to have to deal with. And insurance companies may have exclusions for this, that, and another. Always double down. Have an LLC and insurance. Do them both with affordable strategies. So don't give up on that concept and say, oh, I have an umbrella insurance, I'm good. Oh yeah, good luck. They pay out 1%. The numbers are insane because they're so cheap because they hardly ever pay because there's just so many ways to get around them.
So you're saying with the umbrella insurance that typically when there's some sort of claim, they pay out on 1% of those claims? Is that what you're saying?
Yeah, or less. If you can't even find some of the detail. Now, here, do I carry umbrella insurance? Sure, I do. Yeah. But see, umbrella insurance only pays after your original insurance coverage it does or does not. See, if your regular insurance policy that you should have as a foundation doesn't pay, umbrella isn't required to. It's not like your umbrella pays if your regular insurance doesn't.
Okay.
They're only there as an excess carrier. So if there's a claim in excess of your regular insurance, well, your regular insurance is where the fight starts. You know, is this got meth lab? Is it mold? You know, were you reckless? Were you negligent? Were you this? And if the insurance company says we're not covering this crap, your umbrella is like, woohoo, we're out of here. And so, guys, again, the LLC can be affordably and simply done. And I'm not selling the Nevada Corporation LLC crap. Set up LLCs where your properties are. Put 2 or 3 eggs in one basket. Keep it organized. Keep the LLC maintained with proper minutes, a corporate book, stock certificates, annual reporting. All of that is still important. Just because it's an LLC and one sheet of paper doesn't mean you're good.
Yeah. And I think something that, and we've talked about this before, people get confused with LLCs thinking that you're doing it for tax purposes. It's strictly liability, so that you're kind of, you know, creating a division between you and some of your other assets, right?
Exactly, everybody. An LLC does not save taxes. An LLC gives you protection. Now, if you're going to do fix and flips and rehabs, an LLC is worthless because you're going to have tax problems with those fix and flips and rehabs. We're going to use an S corporation for that. And Eric, you know, we're opening up a can of worms, but that combination of an S corp for short-term real estate and an LLC for long-term holds, even the VRBO and Airbnb vacation rentals, I still put in an LLC. Okay. So just rehabs and flips and commissions that go in the S corp.
So this question might be a little specific, and we may have already addressed it a little bit, but I'll pull it up on screen. Jesse, who's actually going to be on a future podcast, he said that with the opportunity zones, the tax deferment period ends in 2026, he read. So does that mean to get the full 15% reduction, you have to already own the property 7 years before 2026? I think you might have kind of addressed that by the fact that the actual timeline of when you need to get this done by is being established now, right?
Yeah, and you know what, Jesse? Very, very perceptive question, because think about it. What is the government trying to do? They're trying to stimulate the economy as quickly as possible. Mm-hmm. And we're seeing it. You know, whether you're a Trump hater or GOP hater, that's fine. He's crazy on Twitter. I'm with you. But if you're a business owner and you're trying to build wealth as an entrepreneur, you think we'd be better off with Hillary? I don't know. Whatever. I don't want to get political, but even though Trump's crazy at times, these are little incentives that we can take advantage of, and we should be grateful that, you know, don't smack the gift horse in the face. So let's look at this. So what he's doing here, Jesse, is interesting. The sooner you buy the property, you can get into that 7-year time period. My understanding is if you wait 2 years and you still want to do an opportunity zone, sure, go do it, but you're not going to get a 7-year hold. Mm-hmm. So you have a 5-year hold. 2026 is the day of reckoning for this. So the real question, Jesse, is let's say I wait 4 years from now and I buy. Am I going to get the 5%, the 10% reduction? I don't know. And see, this is kind of Congress in the back of the room in the back room with all their little lobbyists and interns, and the senators sit around tables and they try to figure this out. Then they throw it in a bill. Then they let the IRS figure out the details on some of these issues. And so we're going to see some regs come out, and we'll hear more about it. But for now, let's grab the 7 years. You know, we know.
Have they said, is that January 1st, 2026, or is that December 31st, 2026? Do you know?
I know. My understanding is the end of 2026. So when you report your 2026 taxes in April of 2027, sorry, in April of 2027, you'll be paying the taxes that you recognized in 2026.
All right. We did have a question that came in here. This one was from Laura. She was saying that her husband is military. Thank you for your husband's service. We've owned an investment-only property for 6 years. We're considering selling. Will we be hit with capital gains?
Yes. There are a few military tax benefits. Most of it is for income earned in active duty. And that's the paycheck you would get from the government being active duty. And thanks again for his service. But capital gain treatment, you're just in the rest of the crowd with all of us. So you're going to have a capital gain with the feds of 15% to 20% is either going to be a 15 or 20. But then you're going to have your state income tax depending on where you own the property. And this is a nice little distinction. Let me tell everybody this. You don't pay state. If you say, well, I live in Nevada, so I don't have state tax, but your rental is in Arizona, well, you're going to pay Arizona state income tax when you sell that rental. It's not where you live, it's where the rental is. That's where the state tax goes. So people, you're going to have to look at Fed and state. And Laura, maybe you're up for a 1031. It's a seller's market right now in a lot of ways. This may be a time to harvest those profits and turn around and buy something that you off market. You might see something dilapidated. I tell a lot of clients that are thinking of doing a 1031. Here, this is important, Eric. If you're like Laura, this is perfect for you. You're like, yeah, we're considering selling. Don't consider selling. Consider buying. Go out and look at what's available right now. You might be trading apples for apples, but if you say, let's go look at this new area my husband might be stationed. Let's go over there and do a little road trip, or let's fly in, stay in your Southwest flight in a Hampton Inn away, go check it out and go, oh my gosh, there's an opportunity zone here. Or there's some properties here that have better cash flow than what we have right now. Oh, there's a little fixer-upper that's off market before it hit MLS. Let's tie it up. Make an offer of what you're going to buy, contingent on a sale of a 1031. Throw down cash, give them 20, 30 days. Most sellers are going to give you a little time to breathe. Then run back home and put your property up for sale. If you can get what you want, then you can start the 1031. So you've already got the property you're going to figured out. So make sure you're trading apples for oranges and getting something better rather than just apples for apples. It's not worth it.
I guess this hypothetical that you just came up with of her going into this other military base, a question came up. Is there any kind of rules as far as, like, let's say there was like a 3-unit they were going to buy in an opportunity zone? Could they live in one of the units? Has any of that been talked about with that?
Ooh, okay. That's where 1031s get more tricky. So if you were Laura was to go buy a 3-unit, what we would do is we would bifurcate that purchase price. And the 2 units that were going to be for investment would be the actual purchase price. So the 1031 would have to be allocated to the 2/3 of the property, and you'd have to come out of pocket on the other 1/3, or just have a larger loan for that piece. It's a little more complicated, but it's doable, very doable. So if you're out there shopping, Laura, and you see a 3 or a 4-plex, and you and your husband are going to live in a piece of it, think of the sale of your investment property going to buy the other 3 units. And you really have to conceptually think of your unit as a building down the street. And if you can kind of bifurcate that then you'll start to put the numbers together. Now, it could all be one mortgage and it could all be one closing, but on the tax documents, it's going to be split up.
Okay. If anybody has any last minute questions, feel free to comment on the video now. We can try to get to them, but I was just going to kind of do an outro unless somebody sneaks a question in. Yeah, for anybody who's looking to get in touch with you, Mark, what's the best way to go about it?
Oh, thank you so much. The easiest way is to go to my website, markjkohler.com. Mark, M-E-R-K, J as in Jolly, Kohler, Kohler.com. From there, you can go to the law firm, the accounting firm. You can sign up for my newsletter. You can see what workshops are coming up. I've got a whole tax and legal library of videos, 60, 70 videos on all sorts of real estate strategies and topics and tax strategies, QuickBooks training. Anyway, tons of information there at markjkohler.com. And the newsletter's free. You get updates on the podcast. And we just want to be a resource to you. And everybody, let me challenge you. Make sure you have a good tax or legal voice, maybe 2 or 3. And then compare them. And you're the captain of your ship. You should know enough about this to be dangerous.
All right. And I know you mentioned it earlier. You do some like kind of trainings around the different areas like Chicago and Honolulu. Jordan Smith just said that you rock. He's sad he can't make a Chicago area training. Can you tell us a little bit like what goes on in those trainings and what you do there?
You bet. The title of it is called, thanks so much, Eric. It's called Business Owners Workshop. Now, having rental property is having a business. And so I take 8 hours. I always include lunch. We go from 9 to 4, and we and it's 6 hours of training, an hour and a half break, hour and a half, so 6 hours of training, but you spend about 8 hours for the day coming and going. I provide lunch. It's a couple $100. This is not a boot camp in Vegas for 5 or 10 grand people. Yeah. I know it's hard to think of yourself spending money for tax and legal training. So I've had to keep it affordable. And we're going to go through strategic planning, building your board of directors, your board of advisors, how to expand your business, building your 10-year vision. Then we go into the tax and legal updates of this year. What is this new GOP bill really all about? Eric talked about this is the year of the auto. Guys, in 40 years, it has never been this good to buy a car, truck, or SUV. The numbers are off the chart. We got to look at the new dining rules, the new entertainment rules, writing off your kids as part of your employee base. All those rules have changed and been updated. So I cover that. Then we do some asset protection, wealth building. It's a lot of fun. And if you can't come to an event, Chicago, Honolulu, or Orange County, on December 8th, it's a live broadcast. And it's only 99 bucks. You get a recording, you can watch it live. There's live chat throughout the whole day. It's broadcast out of Orange County. And so at markjkohler.com, you can sign up for that too. And it's a tax write-off. It's training for your business. And so you love it. Anyway, thanks, Eric. That's so nice of you. I appreciate it.
And I'll say for anybody who's watching who you own a business and you own rental properties, if you're not talking with an accountant or somebody like Mark, you want to make sure you are, because I know there's tons of advantages and tax advantages that you can have in that situation. So we've actually consulted with Mark at Rent Prep as well. So it's not just something where we're like, hey, this guy's great. Thanks for coming out, Mark. I'll give you a quick plug. Like, we've used Mark. Mark really knows what he's talking about. So we always appreciate your time. We did get one last question. Let me see here. It's about managing properties, property management. Let's see. Can I establish my own property management company in order to write off my salary, charge a percentage fee for managing the properties?
Okay, this is good. This is good. And again, everybody, thanks for your patience with me coughing here. I feel like this is disgusting. I appreciate your patience. Okay, Michael, this is good. Everybody, let me reiterate Michael's question in a different way. You got some rental properties. You want to pay yourself. So you set up a management company and you're going to manage your own rentals. On the face of it, looks like makes sense, right? You're going to pay yourself to manage your rentals. It's actually deceptively very dangerous. And there's only one time we do it. Now, here's why it's dangerous, and then I'll give you this strategy. Why it's dangerous is if you've got a bunch of rental properties and you want to pay yourself, just pay yourself. Take a draw. It's not subject to self-employment income. It's not considered taxable income. It's just it's a draw. Your taxable income for your rentals is rent minus depreciation, travel, dining, computers, electronics, and travel, blah, 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 blah. All the things I want to write off in your rental property business, that's the bottom line you're taxed on. If there's extra cash flow and you want to take it, Michael, take it. You don't have to take a salary. You don't have to take a W-2. It's called a draw. So that's that. If anybody, you want to pay yourself for managing your rentals, look at what the cash flow can allow for and set up a regular payment, weekly, monthly, annually, whatever the hell you want. Now, if Michael pays a management company owned by himself, what did he do? Yeah, he's going to get a write-off for 1099ing himself, but he just created ordinary income now. Now Michael's got to pay self-employment tax on that. Now I've got to think about an S-corp for Michael. And now Michael's like, oh, now I've got bigger tax problems when I should have just taken a freaking draw. But I still set up this structure sometimes. Why would I do it? I'm going to put you on the spot, Eric. Let's have fun here. Why do you think? I'm going to test you here. Now, this is going to make you look dumb because this is technical. So if you don't mind, I'm going to ask you, you take a couple guesses. Why would Michael do this? What is something that he can't do in his property management of his rental properties that he would like to make a management fee out of that? Why would he want to do that? Do you have any ideas?
I'm not too sure. The only thing that came to mind was like a self-directed IRA, because I know you have to go through a property management company for that.
Okay. All right. You're on to something.
Okay.
It's not an IRA, but here's the thing. You cannot fund an IRA or a 401k with draws or passive income. That does not qualify you to fund a 401k, to self-direct, or to fund even a Roth, or to even fund an IRA. Think about it this way. If your only income is rental income, you don't have a job in the eyes of the IRS. You don't have earned income. It's all passive. So you can't even fund a Roth if you wanted to. Now, if Michael says, well, Mark, I want to put 20 grand in 401k this year. In fact, I want to double down with my wife and we want to do 40 grand in a 401k, and I want to take it out of my rental properties and get a tax write-off. Can't do it. Because of 401k, you have to have earned income. So when we do it, Michael, is I pay that management fee over to your S-corp or an LLC taxed as an S-corp or something. We can talk about it. And then we adopt a solo 401k and we zero it out. So I pay you 40 grand, We fund the 401k with 40 grand, zero tax, and you just got a $40,000 write-off in your rental property business. Then you can take that 40 grand and go buy 2 opportunity zone properties. So you just got a tax write-off to go buy more rentals because you paid yourself a management fee and funded a 401k and self-directed it. We set those up all day long. But that's the only time you do it, Michael. Never pay yourself a management fee unless we're going to fund a 401k.
I feel like Michael should be writing you a check for all this information you just gave him. That was great. All right. Well,
So,
I think Laura sums this up nice. She says, thank you. Great info. I couldn't say it better myself. Thanks again, Mark. And like we said earlier, markjkohler.com. Go and check it out. Join the newsletter. Check out the podcast. Again, Mark, thank you so much for your time.
thanks, Eric.